All right, welcome. Ever wondered how literally trillions of dollars zip around the globe every single day? Well, today, we are pulling back the curtain on the world of Forex trading, and we're going to do it by going back to school. So, welcome to the School of Pipsology.
So, are you ready? Ready to dive into the mechanics of the biggest, most liquid financial market on the planet? Let's get into it.
You know, our source material over at babypips.com has this great analogy. It's time to take the green pill, green for money obviously, and see just how deep this rabbit hole really goes. Class is officially in session. Okay, first up, Forex 101. Before we do anything else, we have to build our foundation. We're going to start with the absolute rock bottom basics of what this market even is. So, here's the first thing that makes Forex so different. It's what's called an over-the-counter, or OTC market. That means there's no New York Stock Exchange, no central building you can point to. It's a massive, decentralized, global network of banks all connected electronically. And that's the secret sauce to why it can run 24 hours a day. And this timeline just shows you that 24-hour cycle perfectly. The market literally follows the sun around the world. It kicks off in Tokyo, then hands off to London, and then over to New York. But look at those overlaps. See that? When London and New York are both open, that's when things get really interesting. It's the busiest, most volatile time to trade. It's where all the action is.
So, who are the stars of the show? Well, these are the heavy hitters, the most traded currencies in the world. You've got the US dollar, aka the buck, the euro, which traders call fiver for some reason, the Japanese yen, the British cable, and so on. Yeah, traders love their nicknames, and honestly, learning them is kind of part of the fun.
But make no mistake, if there's one king in this kingdom, it is the US dollar. I mean, look at that number. A whopping 89% of all Forex trades involve the dollar on one side of the deal. It's the world's main reserve currency, which gives it this incredible, unmatched power in the market.
All right, lesson 2. We know what the market is, but how in the world do traders try to figure out where prices are going to go next? Well, it pretty much boils down to two big schools of thought.
So on one side, you have technical analysis. These are the chart gazers. They believe that everything you need to know, all the news, all the data, is already baked right into the price you see on the screen. Then on the other side, you have fundamental analysis. These folks are more like economic detectives, digging into interest rates and political news to figure out a currency's true value. Now, you want to know the real secret? The pros? They don't pick a side. They usually use a little bit of both.
And this is what a technical analyst is looking at all day. On the left, you've got your basic line chart. Pretty simple. But on the right, that's a candlestick chart. And each one of those little candles is just a treasure trove of information. It tells you the opening price, the closing price, the highest point it reached, and the lowest. It's like a visual story of the battle between the buyers and the sellers. It gives you a much, much deeper look at what's really going on.
Okay, let's hit pause for a second. We need to have a serious talk. Think of this as getting called down to the principal's office, because we need to discuss the single biggest, most dangerous thing for new Forex traders, and that is leverage.
So what is leverage? Well, in simple terms, it's when your broker lets you borrow money to control a much bigger position than you could afford on your own. So with just $100 of your own cash, you might be able to control a $10,000 position. Sounds amazing, right? It magnifies your potential profits, but, and this is the big but, it magnifies your potential losses just as much.
And this right here is the most important thing you'll hear today. This quote from our source says it all. I'm going to repeat it. Leverage is the top killer of Forex traders. It's a double-edged sword that is razor sharp, especially for beginners.
See, because leverage blows everything up, a tiny little price move against you can have absolutely massive consequences. If your losses get too big, you get what's called a margin call. That's when your broker just automatically closes all your trades to stop you from losing any more money. And poof, your account can get wiped out. It happens fast, and it is absolutely brutal.
So this brings us to a really crucial shift in how you need to think. You can't be the gambler sitting at the slot machine hoping to get lucky. No, you have to be the casino. The casino knows it's going to lose some hands, right? But it also knows that over time, it has a statistical edge that guarantees it will win. Your trading system, that's your edge. The goal is to manage your risks so that your edge has time to play out.
Which brings us to our final exam. And this isn't about memorizing charts or economic reports. This is about forging the right mindset, the discipline to survive in this game, and maybe, just maybe, eventually to win.
Literally anyone can write down a set of trading rules. I'll buy here, I'll sell there. That's the easy part. The incredibly hard part,
The part that separates the winners from the losers is having the discipline to actually follow those rules when your real money's on the line and your emotions are going crazy. In trading, your biggest enemy is looking back at you in the mirror.
So, here's your homework. First, figure out what kind of trader you are. Are you a short-term day trader or a long-term swing trader? Then, write down simple, crystal-clear rules for when you get into a trade and when you get out. But most important of all, Step 3. Before you risk a single real dollar, you practice on a demo account. It's free, it's fake money, it is the best way to test your system and your own discipline without any real-world pain.
Now, let's be totally real for a second. Even with the best system in the world, you are going to have losing trades. You are going to lose money, period. The goal isn't to never lose. That's impossible. The goal is to make sure your wins are bigger than your losses over time. It's about managing those losses so you can live to trade another day.
So as we wrap up our first day of school, I'm going to leave you with this one question to really think about. When you approach the markets, are you going to be the gambler, throwing the dice and hoping for a lucky break? Or are you going to be the cool, calm statistician, patiently managing your risk and playing the long game? The choice is entirely yours.